All right, coffee is poured, screens are warming up. It is Sunday morning, February 8th, 2026. The markets are closed, but if you listen closely, you can hear the hum of servers spinning up for what might be the most chaotic week of the year so far. We're looking at the tape from Friday to prep for tomorrow's open, and there is absolutely no fluff today. We're going straight to the number. The S&P 500 closed as a neutral doji right at the 20-day moving average.
Which, for anyone visualizing the chart without actually looking at it, is basically the market shrugging its shoulders. It's a visual representation of total indecision.
Yeah.
Open and close at the same price, long wicks on both sides. I mean, nobody knows who's in charge.
Exactly. And the pivot point you need written on a sticky note, put it right on your monitor for tomorrow morning, is 6,045. That is the line in the sand. We saw an intra-week breakout attempt that failed, and it failed with, well, absolutely zero follow-through. So on today's deep dive, we're unpacking this failure, this massive data dam that's about to break, and why this week is, frankly, a minefield for your portfolio.
It's going to be a heavy one. And honestly, looking at the flows from late Friday, the mood has shifted.
You've been scanning the institutional research all weekend. What's the vibe on the street?
I'm calling it macro exhaustion. Oh, you could just feel it in the notes from the big desks. Goldman, Morgan, the macro shops. We've moved from a buy the rumor phase into a cold, hard, show me the data reality.
Right.
We are sitting in a high-stakes equilibrium. And remember, the government shutdown is officially over. That sounds like good news, but market-wise, it means the dam is breaking. We have a backlog of economic data that's been held up, and the market is just tired of chasing narratives without numbers to back them up.
It certainly felt tired on Friday. Let's look at the damage report, starting with the S&P 500. We're still technically riding that ascending channel from, October 2025, so the trend is your friend, technically. Friday was a classic test and reject of support. But, and this is big but, I was looking at the participation. The bounce happened on volume that was 15% lower than the average.
And that is the critical piece of context. You can't just look at price. You have to look at the fuel behind the price. When you see a bounce on low volume, that isn't conviction.
No.
That's just a lack of sellers. It means the smart money is parked. They aren't buying the dip aggressively. They are sitting on their hands, terrified of getting caught offside when the data drops. It's a stalemate.
Now, if the SPX is a stalemate, the Nasdaq 100 seems to be telling a different, slightly darker story. The NDX actually breached the 20-week moving average marginally.
Which is significant. We haven't seen that in a
Well, we
moment.
haven't. It's the first time in 5 months we haven't seen an immediate V-shaped recovery off that level. Usually the algos just step in and buy that dip line because it's worked every single time. They didn't this time. The key level I'm watching on the Nasdaq is 21,150. If we don't reclaim that by next Friday, the premium we've all been paying for AI valuations starts to look less like an asset and more like a liability.
And the flows confirm that. We're seeing actual distribution there. This isn't just retail taking profits on their NVIDIA shares. We saw heavy sell-side spikes on Tuesday and Wednesday. Institutional players are trimming tech. But I think we have to zoom out. The S&P is the anchor, the Nasdaq is fatigued, but the real threat isn't in the equity market at all.
It never is it? It's always the bond market ruining the party.
Always. We have to talk about the U.S. 10-year Treasury yield.
It's accelerating. It's trending up in a really tight corridor.
The pivot there is 4.35%. That is the pain threshold. Listen, we are no longer in a low-rate environment. The bond market is pricing in a higher-for-longer reality that the equity market hasn't fully accepted yet.
Okay, I want to pause here and break this down. We have listeners who trade stocks but might not watch the bond yield every minute. Why is 4.35% on the 10-year the magic number that hurts their tech stocks? Why does one seemingly boring percentage point matter so much?
It's gravity. It all comes down to the math of valuation. Think about a high-growth tech stock. You're not buying it for the cash it makes today. You're buying it for the earnings it's going to make 5 or 10 years from now. To figure out what those future earnings are worth today, you have to discount them back using a discount rate. And that rate is heavily influenced by the 10-year yield.
So as the yield goes up, the math changes.
Exactly. When yields go up, the denominator in that equation gets bigger, which means the present value of those future earnings, it goes down mathematically. If yields break 4.35% and hold, equity PE multiples, especially in the Nasdaq, they have to compress. You simply can't justify paying 30 times earnings for a stock when you can get a risk-free 4.5% of bonds. The competition for capital just gets stiffer.
And right now, the bond market is seeing accumulation. They're positioning for a hawkish Fed.
Exactly. So we have this disconnect. The bond market is bracing for impact, wearing a helmet. The equity market is just standing, waiting.
Let's talk about that waiting positioning. I'm looking at the latest commitment of traders data, the COT report. It tells us what the big money is actually doing, not what they're saying on TV. And institutional long exposure is only at the 45th percentile.
That is incredibly clean positioning. It's almost surprisingly light.
It is. The AI extreme longs have been liquidated over the last 3 weeks, and the retail crowd, heavy in cash, waiting for a signal that just isn't coming.
And this is where it gets fascinating.
Yeah.
This is what I call the neutral trap.
Mm.
Everyone looks at neutral sentiment and thinks, okay, boring market, sideways chop.
Yeah.
But neutral is the most dangerous state for bears.
Okay, explain that. Why is neutral dangerous if you're betting on the market going down?
Because the market is not overbought.
Yeah.
It is underowned.
Hmm.
The consensus trade right now is the wait-and-see approach. You have portfolio managers sitting on, 15 to 20% cash, which is high for them, waiting for a 5% dip to get back in. But here's the paradox. Because everyone is waiting for that dip to buy, the dip won't happen. The bid is underneath the market.
So you're seeing a risk of a squeeze to the upside.
Absolutely. The pain trade right now isn't a crash. The pain trade is a violent move higher. Imagine you're a fund manager. You're underinvested. If we get even a moderately positive data print this week, and the S&P ticks up just 1.5%, you are suddenly lagging. You are forced to chase that rally. It's the short squeeze of the sidelines.
That makes perfect sense. It's institutional FOMO, fear of missing out. And meanwhile, the VIX, the fear gauge, is sitting at 14.5.
Which is pricing in a Goldilocks scenario where nothing breaks. It's suppressed. But experienced traders know that suppression is just the coiling phase before a move.
Okay, so the counter keg is primed. Positioning is light, VIX is low, everyone is waiting. Now we need the spark. And this week, we don't just have a spark, we have a flamethrower. The U.S. government shutdown is over.
Right. And because of that, the agency stopped publishing data. So we have this backlog.
Yeah.
We are walking into a super week of delayed releases. We are getting 3 weeks worth of fundamental economic data hitting the tape in just 5 days.
It's going to be a chronological gauntlet. I want to run through the red folders. This isn't just news. This is the data that moves the algos.
Let's do it.
Tuesday, February 10th. We kick off with U.S. retail sales for December and the employment cost index for Q4. Retail sales usually grab the headlines, but you're focused on the cost index. Why?
Because the Fed is terrified of a wage price spiral. If the employment cost index, the ECI, comes in hot, it means companies are paying significantly more for labor. If they pay more for labor, they have to raise prices. That feeds the sticky inflation narrative immediately. If ECI is hot, bonds sell off, period.
And Wednesday, February 11th, a doubleheader, we get the delayed U.S. non-farm payrolls for January.
This is the big one for growth. We saw unemployment tick up to 4.4% in December, and the market freaked out a bit. We're looking to see if that 4.4% was a floor or the start of a trend. But don't sleep on the other print that day, China CPI.
Right, China CPI. Why are we watching that?
Because China is the engine of global demand. We're looking for deflationary pressure. If China's CPI stays sub 1%, or worse, goes negative, it tells us the second largest economy in the world has incredibly weak demand. That's a huge headwind for commodities, for oil. You can't have a global bull run if China is exporting deflation.
Then Thursday the 12th, we get UK GDP.
That's on stagflation watch. The Bank of England is completely trapped. That print will move the currency markets, the pound, the dollar index. And if the dollar strengthens because the pound collapses, that spills over into our equities.
And then the main event, the boss battle. Friday, February 13th, the delayed U.S. Consumer Price Index CPI for January. A literal Friday the 13th print.
The scriptwriters really outdid themselves, didn't they? Listen, this is the only number that matters for the Fed's March meeting. Everything else is just noise compared to this.
So let's game out the binary risks here. Scenario A, hot labor. Non-farm payrolls come in over, say, 150K jobs added, and wage growth is over 4.0% year over year. What happens?
If that happens, the soft landing narrative dies on the spot. The market prices out a March rate cut instantly. You'll see the 10-year yield spike right over 4.25%, maybe even test that 4.35% pain threshold, and the everything rally just hits a brick wall.
Okay, that's the rate scare. Now, scenario B, sticky inflation. CPI on Friday comes in hotter than 0.3% month over month.
Then inflation is proven sticky at the worst possible level. The U.S. dollar rips higher. When the dollar rips, emerging markets bleed. And growth stocks, specifically those AI-adjacent names, they face a swift 3% to 5% correction. It's the good news is bad news regime all over again.
It's a minefield. So knowing all of this, the technicals, the positioning, the data, what is the actual game plan for Monday morning?
The theme is simple. Rates up equals duration down. You have to protect against duration risk.
Let's define duration real quick for anyone new.
Duration is just how sensitive an asset is to interest rate changes. High duration means it crashes when rates go up. Low duration means it's safer.
Got it. So which sectors are most exposed?
Two specifically, real estate and technology. Look at REITs. They are the ultimate bond proxy. If I can get 4.5% risk-free in a treasury, why would I buy a risky office building REIT paying 5%? I wouldn't. Residential REITs are particularly vulnerable if mortgage rates jump back towards 7%.
And technology.
Just like I said, it's high duration. You don't want to be holding the bag on high multiple tech if yields are ripping. You want to be in things that have cash flow now. Energy, financials, maybe healthcare.
So execution strategy. Market opens in less than 24 hours. What are we doing?
Stay light on size. This is not the week to be a hero. Do not put on hero trades until we see institutional volume return to the buy side. We need to see if they defend the line.
And the trigger to engage.
The trigger is that SPX 6045 level we started with.
Okay, let's unpack that. If we are trading above 6,045.
Then we are in a buy the dip regime. It's
Yeah.
consolidation. You can look for tactical longs in those cyclical sectors. The market is digesting.
And if we break below 6,045.
If we break that and close below it, the mood turns sour fast. The structure shifts toward 5,800. But, and this is my final thought, do not bet on a crash just yet.
Why not? Everything you just said sounded pretty bearish.
Because commercial hedgers are net neutral. They aren't short. The real risk is a squeeze higher if the data is just. Okay, if the data comes in and it's not a complete disaster, that cash on the sidelines has to come in. The bar for a rally is actually quite low.
It comes back to that short squeeze at the sideline.
Exactly. Sometimes the biggest risk is being out of the market when the relief rally hits.
All right. Let's recap the line in the sand. SPX 6045. That is your pivot. If we hold it, we breathe. If we break it, buckle up. The market is closed now, but the volatility returns tomorrow morning. We have a massive week ahead. Watch the bell.